Welcome to Cambridge House Live. I'm Bridgitte Anderson. I'm joined now by John Kaiser. He is the founder of Kaiser Research Online. Welcome and thank you for being here.
Thank you, Bridgitte, for having me on.
Tell me, what is your research telling you about the global economy right now?
Well, we're seeing the slowdown in China has stabilized. We see the economy picking up there again. The Eurozone, the anxiety about imminent collapse, that has also diminished. And in the United States, I think we just have to deal with the debt ceiling issue, hopefully an executive order that simply cranks it up to $22 trillion and allows the administration to get on with growing the economy. And I think we'll see this sort of slump that everybody's expecting dissipate and get back into an uptrend of global GDP growth.
Are there any implications for investors if the U.S. government does raise that ceiling? Is there a reason to be concerned?
There are no implications whatsoever. These are the deficit that's projected is based on laws that already exist to a large degree on entitlement programs like Social Security, Medicare. The Social Security problem is easily solved by increasing the threshold for payroll taxes from $110,000 to $160,000. As far as Medicare is concerned, they definitely need to do with the fact that people spend 90% of their life's medical costs in the last year of their life and don't particularly enjoy it. So that's an area where I think a lot of choices will be made. There's efficiencies to be gotten out of the big pharma and the healthcare industry. It's an unpopular area. Nobody wants to tackle it, but it can be fixed. This is a possible debt. This is not a paper money printing type of debt. Doctors don't get paid in paper. They deliver real services.
And as far as the overall debt, though, you see this as something that can be solved fairly quickly.
The United States desperately needs its economy to start growing again. That's the only way they can cope with the demographic bulge that's moving into retirement, the boomer generation. And growing the economy, you can outrun it, you can stabilize the percentage that the deficit is. In the oil and gas sector, I mean, we see now self-sufficiency, we see big improvements there which can turn around the current account deficit and so on. But growing the economy, that's the solution.
2012 was a rough year for the junior mining sector. What do you see is happening in 2013 for investors?
2012 was a year where political agenda basically wanted to throw the American economy so that a Republican administration could be elected in all three parts of Congress. And so there was holding back on everything. There was a big call for austerity everywhere. All of that had the potential to tip the U.S. economy back into recession, the global economy possibly into a depression. So in the resource sector, people saw, okay, the super cycle is dead. We're not going to see demand keep growing. China desperately needs a growing global economy. If the United States pulls the plug on itself, then China has a serious problem. And then we all have a problem because in the long run, we're all counting on a strong Chinese middle class to keep all our mature economies chugging along in the future.
So do you see that the Chinese economy then, it is back on track? It has slowed somewhat, but it's still growing now, which is good for the resource markets then? Yes,
we're starting, even in the real estate market there, which had stalled in a big way, we're starting to see a turnaround. In terms of, I watch the rare earth sector very closely, and we still haven't quite seen a bottom in the rare earth prices after the big run-up in 2011. And in the minor metals, they're sort of a leading indicator. We haven't quite turned the corner yet there, but we are seeing stabilization of the drop in demand for raw materials.
So we haven't hit bottom yet?
We are very close to the bottom if we haven't turned it already. We're waiting to see some of these minor metal prices like tungsten and that after their pullback turn around again and drift upwards. And the big thing with the juniors is metal prices for things like copper and gold have stayed quite high. And yet we've seen a serious disconnect in the equities. Part of the problem has been severe cost escalation in the mining sector, running 10% versus the 2% or so in the overall economy.
Do you think that's going to correct?
I think the cost escalation has corrected. China really surprised everybody in 2009 when they said we're going to spend $600 billion to reverse the effect of the 2008 financial collapse, and that put enormous pressure on raw materials for that two, 3 year run. And they then pulled back because they were the engine of their own inflation. And so there's been some, a reluctance to continue stockpiling, but there's signs that that's going to happen again. And I think copper's stable at $350, gold is stable at the current price. And things like nickel, metals like nickel will start to go, zinc will start to creep up. And gold, well, I think it's stable here with potential to go over $2,000, not because the world's ending in a hyperinflation flame out, but simply because...
You don't see that 3,000 then in the near range?
No, I look at gold in terms of an anxiety index. I look at all the gold that exists as a function of global GDP. In 1980, it was 26% when it hit 850. Right now, it's about 12%. And you take the value of the 5.4 billion ounces of gold and divide that by global GDP, which is about 67 trillion. So that's about 12%. Gold to be at the equivalent of anxiety in 1980 would be about $3,200. So I could see a radical spike if, say, Israel decides to unilaterally bomb Iran and we have the whole Middle East go up in flames. So that type of destabilizing geopolitical event would send gold to 3,000 in real terms.
But sentiment has got a way to go to get there, is what you're saying.
Yeah, in terms of like just grinding there, no. I think we have systemic anxiety going forward as the United States transitions from the sole military and economic superpower to one that's more balanced, perhaps even eclipsed by China. A world 2030 where the US dollar is no longer the single reserve currency. There's just a natural accumulation of gold by people who have accumulated wealth to stash some of their wealth in a form that's transportable and that will still be there when all kinds of political chaos or economic chaos happens around the world.
And what are you telling your subscribers about the next frontier, exploration frontier?
Well, I'm telling them that for the advanced projects, all you need to do is wait for the market to accept that metal prices are going to do nothing worse than nothing. And when the general market understands that, the majors will move in and clean out the best of the remaining advanced projects that were dredged up during the last decade and pushed forward by the juniors. And when that disappears, there's going to be a vacuum, because I don't see metal prices in the short term going up significantly. And there's going to be all this capital there and interest in this sector, and it's going to have to go back to what reigned in the 80s and 90s, discovery exploration. So where do you go? Well, the whole world's been scoured. All the easy low-hanging fruit has been found. You don't see outcropping escondidas or anything like that anymore. So you have to go deep into the third dimension, blind, buried, covered deposits. And I think a place where there's 300 million more ounces of gold left to be found is Nevada itself, where most of the gold is controlled and was mined by Newmont and Barrick in a couple of main trends.
But there's more there, you're saying.
That's right. Because of the unusual topography of Nevada, where half of it was dropped down and the other half popped up, and then creating this basin and range topography, the gold, which was all deposited before that, half of it is hidden under gravels. And when people realize that there's all kinds of potential for deposits outside the main trends, I think we might see the flanks of these basins staked wall to wall by juniors, giving us something we haven't seen in the past decade, not since, say, the Labrador Voisey's Bay area play or the diamond play in the Arctic that kicked off in 1992.
And so how soon can investors expect to see that?
Well, it would start with the next drill hole. One of the companies I follow, in which I am a shareholder, Nevada Exploration Inc., generated a prospect that's within view of Cortez Hills, except at a different angle from it, that has the scale of Pipeline, Cortez, and Gold Rush all combined, which hosts 60, 70 million ounces. It's farmed out to McEwen Mining. They will start drilling sometime this year, and if the model as to what's there proves correct, this could be an enormous discovery play, not just for these two companies, but by the implications this would have as to where else you should be looking in Nevada for very big league discoveries. It may not be them, it could be another company. So the short answer is, I don't know quite when, but I think it will come.
All right, we'll be watching. John, thanks so much.
Thank you.